I'm Emily Chang, and this is the best of Bloomberg Technology, where we bring you all our top stories from the week in tech. Coming up, Amazon beats on revenue, but a big miss on earnings, what the second quarter scorecard means for the online retailer's bottom line, and founder Jeff Bezos. Plus, Meg Whitman steps down from the board of HP Inc. Could this be a preview of a bigger move to come for her? And Samsung unscathed. Despite the crises within over the first half of the year, business is booming for the South Korean conglomerate. How it's come within striking distance of Apple's top spot as the world's most profitable company. First to our lead. Amazon shares dipped post-market Thursday after the company reported disappointing financial guidance, especially its projection of a potential loss in the third quarter. The company's second quarter earnings per share of 40 cents missed the lowest analyst estimate. The results showing that Amazon is preparing to step up competition with rival Walmart and cloud computing challengers Microsoft and Alphabet. We broke down the numbers with Technalysis Research President Bob O'Donnell and Bloomberg Global Head of Tech Coverage Brad Stone.
This is a company that's investing. There's a cost to all that free video that Amazon is lavishing on its Prime members.
So where are these expenses? Is it video? Is it fulfillment?
I mean, they don't specify, but it's video and fulfillment. I mean, they're building fulfillment centers closer to cities. That's why they can get you stuff in one day. They're making all these great shows like Transparent and The Man in the High Castle. It costs money, and every so often investors get jittery. But we should say the stock is down 2%. I mean, this is an unflappable shareholder base, and it will be probably right back tomorrow because there's still this incredible halo over the company.
Shares right now down more than 3%. Bob, what's your take?
Well, I think what's amazing about what Amazon does from a long-term perspective, and this is why Bezos is now, number one, or maybe now he isn't.
He's number
one,
two.
Anyway, point is, they're able to take investments, long-term investments in infrastructure, and turn them into products, right? AWS was the first example, but as they build out these warehouses, as they build out technologies for stores without people in them, they're going to be able to license these things that they would have to do anyway and turn them into products. And that is a very smart, shrewd, long-term perspective. And I think that's what people are buying into.
What about Whole Foods, Brad? Are we getting any more clarity on how this acquisition will play out, how it will impact the bottom line, how exactly this company will be integrated into the Amazon empire?
The answer is no. The deal hasn't closed yet. They were asked about it on the media call at 1:30. The CFO, Brian, declined to comment on it. It hasn't even passed antitrust, regulatory review. We're not even sure, if there will be regulatory scrutiny at any advanced level. So, they're not talking about that, but we can see that groceries is a major avenue of expansion for Amazon, not just the Whole Foods purchase, but Prime Now. They just entered into Singapore with Prime Now. Amazon Fresh, they're expanding. So, hopefully in the coming weeks and months, we'll learn more.
I'm also interested, Bob, in how the dynamics between brands at Amazon are changing, with Nike and Sears now selling directly to Amazon.
Well, again, what you're seeing is them building out this infrastructure capability to deliver goods in another way. I mean, another thing I didn't mention is they're becoming a logistics company as well, right? So they're building the logistics they need to do groceries, which nobody's really solved yet, and Bezos loves solving problems. They're building the infrastructure to deliver other kinds of products, and they're going to take that ability, and they're going to take those skills, license them, and figure out ways to make money not only for themselves, but for other people potentially as well.
So look, we'll see how investors respond to this tomorrow, but Brad, is the confidence in Bezos deserved?
Yeah, I mean, you look at a 20-year history as a public company, and just for consistency, he kind of called a shot early on about how he was going to run the company, on free cash flow, investing for the long term. They've periodically signaled that they're entering into investment cycles where they'll spend a lot of money on things like fulfillment centers, and they operate the company with a lot of discipline. So they give you these broad estimates, but they always hit those estimates, and you do that enough times, and investors really begin to trust you. So I think he's earned a level of trust at this point.
Do you think, Bob, that this deal will accrue any antitrust scrutiny, the moves at Amazon?
Well,
how big is too big?
Well, that's a fair question, right? And as, again, they build out all these infrastructure capabilities, they start to have a larger influence even than what they're selling themselves. And of course, in the current environment and with his ownership of the Washington Post and the way Trump views that whole thing, you got to imagine, unfortunately, there's some incentive to say, yeah, you know, maybe we should look a little that direction.
Yeah,
and despite the fact that they sat next to each other at that meeting at the White House, they're not the best of friends.
No, I mean, look at the president's tweets. But, you know, by any rational measure, it probably should, you know, pass antitrust scrutiny. Whole Foods is a small player. Amazon has no presence in groceries. But we are in a topsy-turvy political environment. Right. And yes, I mean, this could get scrutiny just because Jeff Bezos right now is not the most popular guy in Washington.
And yet there is this frenzy of speculation about what will be Amazon's next big bet.
Well,
any ideas?
Let's not forget what they're doing with Alexa and voice-based computing. Small for now, but a very interesting play when we look at the perspective of they were never able to really do anything from an operating system perspective, right? They really wanted to compete against Microsoft and against Google/Alphabet and Apple. And now all of a sudden they're coming in from the side with this voice-based computing thing and all of a sudden opening up lots of different avenues. And oh, by the way, the beauty of it is across all of those platforms. So that's one to watch.
And we have to talk about the cloud, where they are the leader, and yet we saw progress at Google on this front, progress at Microsoft. You know, the pie itself is getting bigger, but does Amazon have to worry about the competitive threat there?
I mean, the pie is getting so much larger that it's lifting all boats.
Lifting all boats.
The challenge is when they enter into these periodic price wars and it depresses the profitability of the cloud segment. That goes on and off. I don't think right now we're seeing it. The business looks very healthy. They're hiring a lot of people. They've talked about that on the calls. But, you know, this is a very hotly contested space.
Amazon shares, good for your portfolio? Good for Bezos, but good for your portfolio?
Long run, I think so.
That was Technalysis Research President Bob O'Donnell and our Bloomberg head of global tech, Brad Stone. Now, in other earnings news this week, Twitter failed to attract more monthly users in the second quarter. Investors had been looking for evidence the company is on a path of sustainable long-term growth. Revenue fell 4.7%, and Twitter's net loss also widened, affected by a $55 million write-down in its investment in music streaming service, SoundCloud. Meantime, Facebook churned out faster than expected quarterly sales growth, fueled by continued strength in mobile video ads. The social network now has over 2 billion monthly active users and is steadily driving revenue at a faster pace than other tech giants. Facebook has also been heavily investing in original content. The first shows are expected to come online in August.
So we're seeing a lot of content viewing and content engagement shift to mobile. And our goal is to be a platform for content providers to find their audience and monetize. Right now, we're doing some early investing in kickstarting the ecosystem to promote more episodic video viewing on Facebook. We have a lot of video views on Facebook, but not really of that kind, and we think that kind's important, so we're making that investment. Over the long run, our goal is to be a platform and have content providers creating that content and finding their audience.
My interview there with Facebook COO Sheryl Sandberg. Now, Alphabet was also out with earnings this week. Revenue for the search giant coming in at $26 billion, up 21% year over year. But aggregate cost per click dropped 23% from a year ago. The numbers include the effect of the $2.7 billion fine from the European Competition Commission. I spoke with CFO Ruth Porat about this fine, and she told me, quote, "It is so early in our analysis of this decision, this is an ongoing legal matter, and that they haven't decided yet if they will appeal." We discussed this with Colin Colburn, analyst with Forrester, and Bloomberg TV editor-at-large, Corey Johnson.
I think the reason the stock is down is because of traffic acquisition costs. The company has been warning us for some time that as they shift away from ads on a website to ads on a mobile device and ads that are programmatic and ads that are on YouTube, that the cost of, not on YouTube so much, but programmatic ads and mobile ads, right? So for example, when we're on an Apple iPhone and we're seeing ads within an app, those may be served through Apple by Google. Google ad salespeople out there making those sales calls, bringing in those ads, but they're selling them through it to Apple. Well, it's more expensive to acquire that traffic, that is to acquire those Apple iPhone users, for example, for Google. So Google's costs for those ads, the traffic acquisition costs, have been rising.
So you think this is more about traffic acquisition costs than cost per click being
than
down?
anything else. I think that's what it is. I mean, because they've warned this is a big change in their business, that they're going to be more mobile and more programmatic, and that it's going to start to cost more. This time we saw it.
All right, Colin, what's your take? And in speaking with Ruth Porat, she really singled out the strength in mobile search as well as YouTube in terms of driving the momentum here.
Yeah, you know, I think mobile's the big driver here. That's kind of the headline. I think that's why you see increase in clicks and also a decrease in cost, in aggregate cost per click. You know, I think that's been the big driver, the big storyline for Google for some time now.
Now, what about what's going on with YouTube? You know, we talked about Adpocalypse earlier this year, whereby the Times did a big investigation into extremist content that was shown next to some very prominent advertising. A lot of advertisers pulled their campaigns. It seems like those advertisers have returned. I did ask Ruth Porat about this, and she reiterated that revenue across the sites was strong. That benefited in particular from mobile search and YouTube. We continue to take very seriously this issue, and we are doing all we can to protect the ecosystem. We've already written a lot about it.
Yeah, I mean, look, a lot of advertisers made a lot of noise about this, obviously, but they also liked the advertising that they liked the traffic that overall that Google was giving them in terms of clicks from their ads. I mean, the Google ad is like nothing else in the history of advertising in that you actually can see the result of an ad as it runs. And the advertisers obviously like that because it's where they're shifting their ad dollars to. So to the extent that advertisers actually pulled ads a year ago, 9 months ago, it actually is probably good news for Google now because they've fixed what little problems may have been there. I say little problems, extreme content is a serious problem, but I don't know how big these ad problems really were for these advertisers, and it looks like they're all back. None of them stayed away for good. So I think what's interesting here is that it actually might make the comparison numbers look better for Google going forward.
Now, Colin, there's these ongoing investigations in the EU. We had this big $2.7 billion fine. Google is still trying to decide whether or not they're going to appeal here. How concerned are you about future investigations?
Yeah, I think from an advertiser perspective, there's lots of concerns. You know, obviously the YouTube scandal earlier in the year, and now the ruling from the EU, from the Competitive Commission, doesn't really help an advertiser's stomach when going to invest in advertising on Google. How do you know that your ad's not going to get placed in a position that you don't want it to be? And how do you know that if you're buying things like product listing ads or the shopping ads, that it's not being skewed against you? So there's obviously some issues, but I kind of agree with Corey that I think this was a good thing for Google. I think in the long run, with advertisers pulling out, and Google's able to identify, you know, what do we have to do going forward? What do we have to work on to kind of instill better trust in our advertising partners?
Colin Colburn there, analyst with Forrester Research, and our editor-at-large, Corey Johnson. Later on in the Best of Bloomberg Technology, the war of words between two tech billionaires. We'll dig into the beef and barbs traded between Elon Musk and Mark Zuckerberg over artificial intelligence. But next, Meg Whitman is officially off the board of HP Inc. What it signals for her tenure as the CEO of the other company, HP Enterprise, next. This is Bloomberg. U.S. President Donald Trump has announced that Taiwanese manufacturing giant Foxconn will build a factory in the state of Wisconsin. The $10 billion factory, which is expected to produce LCD display monitors, will initially employ 3,000 people. That number could eventually swell to 13,000. The move fulfills a promise by Foxconn President Terry Gou to invest in the United States.
Why do it here? TV was invented in America. Yet, American does not have a single LCD fab to produce a complete AK system. We are going to change that. It starts today with this investment in Wisconsin.
Meg Whitman is stepping down from the board of HP Inc. Whitman will be replaced by Chip Bergh and will remain the CEO of HP Enterprise, which split off from HP Inc. in 2015. The news comes on the heels of our reports that Whitman is on the short list of candidates to fill Uber's vacant CEO spot. The ride-hailing giant is said to be planning to name a new CEO by September and has narrowed its search to fewer than 6 contenders. We discussed this with our Bloomberg Tech reporter, Eric Newcomer, who covers Uber, and Akamai CEO David Kirkpatrick.
She's long been someone in my mind that I thought was a possible candidate. I've been asking about it all the time. She's been advising Travis. She's close to Ryan Graves, their board member and former CEO, early CEO.
And she's also an early Uber investor.
Yeah, right. So she's just been in the mix and sort of has the statesman-like reputation, the experience running a big tech company, like a lot of the pieces that you would imagine. So she's, it's not a guarantee that she's going to become the CEO. She's definitely in the mix. One of 5 or fewer candidates sort of left, and the hope, like you said, is to get it together before Labor Day, around Labor Day.
David Kirkpatrick, our Bloomberg contributing editor, still with us. David, what do you think of Meg Whitman as the choice?
Actually, I was just thinking, listening to Eric, there is an interesting analogy between what Meg Whitman really did wonderfully well, which was run eBay, and Uber. They're both marketplaces. They're both places where you bring buyers and sellers together effectively. I think it's actually the kind of company she could run better than she has been able to run HP and HPE. So, you might say she's a little generationally too old for this sort of thing, but she's a Silicon Valley veteran. I think she brings a lot of the right characteristics to the job. So I am, relatively optimistic that she would be a strong candidate at a minimum.
Now, Recode, Eric, is reporting that Whitman is unlikely to take this job and may not even be a top contender. What's your reaction to that?
She's definitely a top contender. I mean, HP's statement to us was sort of like, she's going to be here until the job is done, which is super vague. I don't know. Rico and I just sort of disagree on this one.
That was our Bloomberg Tech reporter, Eric Newcomer, and Techonomy CEO, David Kirkpatrick. Coming up, venture capital funds keep getting bigger. We will chat with Maha Ibrahim, general partner at Canaan Partners, on their record-setting latest fund. And later, competition in the augmented reality space is heating up. How UK-based Blipar plans to carve out its place in the increasingly crowded field. This is Bloomberg. In funding news, Canaan Partners closed its latest fund at $800 million. It's the firm's 11th fund and its largest in its 30-year history. Venture funding has been ballooning this year to highs not seen since the dot-com bubble. The surplus of cash helps startups stay private longer with money that would otherwise be raised on the public markets. We spoke with Maha Ibrahim, general partner at Canaan.
Our firm is a diversified fund, unlike a lot of others. So about 40% of what we do is healthcare and 60% is tech. On the healthcare side, we've had an incredible run of exits, largely due to the fact that we've been very disciplined in certain areas. Same goes for tech. And yes, we feel like there are a lot of areas.
So you've been at Canaan for more than a decade, so your memory goes back. I mean, what do you think of these comparisons to dot-com times?
There's no question that we're in heady times right now. But on the other hand, there's still so many companies that are amassing an incredible amount of revenue, traction, et cetera. I don't see that ending. I don't see a cliff like we saw in the 2000-2001 period. And frankly, there's no reason for that. There's a ton of momentum. There's a ton of money flowing into the system.
On one hand, you have companies staying private longer. On the other, you guys had like 30-some exits in the last 3 years, which is 3 times the average.
Yes.
How is that possible?
In addition to that, what we've seen is that some of our companies have been exiting a lot faster than they normally would. So our average time to exit for our deals has been less than 4 years, and this is both in tech and healthcare. We think it's because we take a franchise approach towards investing. So there are areas that we just go very, very deep in, and we mine them. We mine them in terms of networking, thesis, et cetera. And that's the secret sauce to Canaan.
If a company, if you get the sense that a company would take 10 years to go public or 10 years to exit, would you stay away from that?
No, no, no. We absolutely believe that we're building companies for the long term, but because we're taking this more thesis-driven approach towards investing, we're on the pulse of what the acquirers want and are thinking about, and that just inevitably causes companies to exit faster than they otherwise would. And then there are some that take 15 years, and that's fine too.
So what areas are hot where you think there are big opportunities? Where are you going to put this money to work?
So fintech is still very hot for us, financial technology investments. We spend a lot of time there in real estate and in insurance. We spend a lot of time in cloud, where I spend the bulk of my time. You'll see us do a few gaming deals, again, in e-commerce. And then on the healthcare side, anti-infectives, immuno-oncology. But again, very disciplined in our approach, as opposed to taking an index fund for venture.
Canaan is also celebrating 30 years.
Yes.
As a VC. You have 3 female general partners, which is 2 to 3 more than most other venture capital firms. And I'm curious how that changes the environment inside the firm and into the investments that you make.
It has been such an incredible, I'm incredibly fortunate to be at the table with my 8 general partners, and 3 of them being women. The conversations, we feel, are just a lot more inclusive. And as a fund, we feel like we're reflective of what the true entrepreneurial pool looks like. So that if a woman or an immigrant comes in the door, they're surrounded by people that have had similar experience that they've had, and frankly, much more comfortable.
I know you've been following this spate of sexual harassment stories. VCs have resigned, lost their jobs. Of course, there was a sexual harassment investigation at Uber. Are you surprised by this?
The unfortunate thing is that I'm not surprised. I'm surprised at the horrific nature of it, but I'm not surprised that it's happening. The problem is that, if there is a positive spin on this, it is this. The sexual harassment has happened. I'm sure there are more cards to fall, unfortunately. But it's really woken people up to the need for diversity and inclusion, both at the venture and senior investing table, but also from an entrepreneurial perspective. We need to be bringing up women entrepreneurs, people of diverse backgrounds into investing roles so that all entrepreneurs feel welcome.
When you say more cards to fall, I know everybody is calling everybody. I'm curious, what kind of calls are you getting?
I am getting a lot of calls. I'm probably spending about an hour to 2 a day, either talking with entrepreneurs. I'm on the board of the NVCA, so the NVCA is taking a really serious look at what's going on and thinking about how to approach this topic in a holistic way. Talking with limited partners of ours. It's certainly top of mind. But
talking
again,
about what?
Talking about the fact that it is happening, talking about what we can do. Can we put notions into term sheets? Can we have, again, a more diverse pool of investing professionals around the table? There are many things like hotlines. So there are many notions being talked about right now, and my hope is that we can all come together as groups and, again, make this a more diverse and inclusive environment for venture and then spilling over to the entrepreneurial pool.
And I know women entrepreneurs have often come to you, and
Yes.
you've been their advocate. I'm curious, have you ever found yourself in a position where you're a co-investor with someone who there's bad behavior alleged against that person, either before or after the fact?
I have been very fortunate for that not to be the case, but I'll tell you, I see female entrepreneurs on a daily basis. To a person, each one of them have told me a bad story. And this has been happening for 17 years in my career. So by no means is this a new thing, but we've got to put efforts finally into making it stop.
What are those efforts? I mean, signing a decency pledge is sort of great in theory, but shouldn't everyone just be decent?
It's an incredibly low bar.
Do you need to sign something?
No, we shouldn't need to sign something. But, and I've said this again, I firmly believe that a huge part of this bad behavior stops when you have females and minorities at the investing table and in senior investing roles, because stuff like that will not happen. Their behavior will be checked. And again, from a social psychology standpoint, I'm going to want to invest in people that look like me. So at my firm, we have 3 investing professionals out of 8 as female, the GP role, 40% are females, 25% of our companies were founded by women. That's not an accident, nor is it something that we did purposefully. It just happened.
The average is more like 6.
That's right.
6%
We've reached a
or so.
tipping point, and as an industry, if we can reach a tipping point, we've won.
That was Maha Ibrahim, General Partner at Canaan Partners. Coming up, we speak exclusively with Akamai CEO Tom Leighton and dive into the company's second quarter earnings report. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Emily Chang. Cloud delivery platform Akamai reported better than expected second quarter revenue. The company boosted its top line by $609 million. That's a 6% year-over-year increase. But forecasts missed estimates, and this week the company's stock sank to its lowest level in at least a year. Akamai CEO Tom Leighton joined us in the studio for an exclusive interview.
The important thing to realize is traffic is growing at a very rapid pace. We have lost some share to do-it-yourself efforts in the Internet's largest platform companies. Outside of that, our traffic growth is bigger than the Internet as a whole, so you can infer from that we're gaining share. And I think the important thing to take away from the Q2 results is that now our performance and security business, our web division customers, is the majority of our revenue. Very profitable business, growing at 16% year over year. Our security business in particular, now almost $500 million. We expect that to be $1 billion within the next 4 or 5 years, growing at 34%.
You mentioned security revenue there is still strong, but slowing down, and I wonder, is that just the law of large numbers? Is that because you've passed the early adopter stage?
Well, you know, growing at 34% is pretty good when we're the world's largest pure-play cloud security provider, and we think there is strong growth, ahead, enough that we're confident that we can make that $1 billion business. Also, we're just now launching our first 2 enterprise security products. And we think in the long run they have even more runway than the existing web security business, which has been very successful.
So when do you think we'll start seeing some of those new products contributing to growth?
I think next year we'll start seeing the enterprise products, contributing. And so far they're on a track record that exceeds what we did in the first year with our web security products.
So I'm curious, you obviously see a lot of what's happening with streaming services like Sling TV, YouTube TV, Hulu Live, some of these new fledgling services. Can you give us any color on how quickly these services are being adopted? You know,
that is a great question, and we deliver for a lot of those companies. And, video now is the majority of traffic on our platform and growing at a very good clip. And that's what makes us really optimistic about the future of our media business. And the question really is, how fast will the adoption be? I think everybody in the industry thinks that over a period of years, the majority or maybe large majority of video watching will be on the Internet.
That was Akamai CEO Tom Leighton. Well, phone-based augmented reality is on track to become a major trend in coming years. But it's not just major tech giants that are making a play for the field. London-based Blippar recently launched a facial recognition feature for its app that claims it has more than 99% accuracy and can recognize 370,000 public figures. Bloomberg's Caroline Hyde caught up with Blippar COO Danny Lopez and started by asking about the business applications of its latest feature.
So the facial recognition within our app, we've launched in beta. So it's fun, it's social, we want people to play around with it, we want to learn from the experience. The key for us is the accuracy of the recognition. So our facial recognition has a 99.67% accuracy rate, and that's what we want to make sure is working, and it's working extremely well. Because once you have that, you can take that from our app and use it in a whole host of sectors. So think mobile banking with identity management and facial recognition as a way to be able to transact. Think building access, where gone are the times where you're sort of faffing around to find your card, but actually there's a camera lens that recognizes you as an employee. So many different smart networking. The conferences we go to with 5,000-10,000 people, trying to figure out who's who might be relevant to you. Having the ability to be able to just scan a photograph from a brochure or in person and getting that information is extremely exciting.
Security. Are there issues or worries about that as well? I mean, in terms of being able to just scan a picture of anyone and know the details about them. At the moment it's opt-in, but how does that scale?
I mean, security is a key area, not something that we are working on right now, but I think like everything, you've got to embrace the technology. So at the end of the day, if you acknowledge that facial recognition gives you the ability to find where the bad guys are, that's a very positive development. People talk a lot about privacy issues, but think about the person who's in a foreign city, who faints, falls down, has nothing on them. The ability for somebody else to come and, through facial recognition, be able to find nationality, send that person to the closest embassy, next of kin, or maybe some medical information, that saves lives. So there's a real debate about privacy, but there's also so much value add this can bring.
So what is Blipper now? Because when it first launched 5 years ago, it was very much about branding and about exciting ways of using it and brands getting access to you and I. What do you want to stand for now?
So we're a technology company that specializes in augmented reality and computer vision. So a lot of people think of us as Blipper, the app. The app, in a way, is the showcase of the technology. So we've made a very clear decision that to be able to scale, as I was saying earlier, AR, you need to be very good at computer vision. So we think that when you have that perfect marriage between augmented reality, i.e. overlaying digital content onto something, with computer vision, i.e. true recognition and cognition, you have, as I say, perfect marriage that will allow AR to scale. So we're both, and we essentially provide people the ability to get more from the world in front of them. That happens within our app, but then the technology that we've built can be taken outside our app and used by companies in other sectors to be able to capitalize on the great progress that we've made on computer vision.
You said, of course, you've been investing heavily. What does that mean in terms of money? Are you looking towards profitability or break even? How do you start to make sure that you can make this a revenue driver as well?
Yeah, I mean, look, first of all, we already generate significant revenue from the brands that we work with. But we take a long-term view here, which is that we're building something pretty ambitious. We're cataloging, we are indexing the entire world. And to do that, you need the best engineers in the field. We've got a lot of those here in London. We've got a lot of those over in the West Coast, in the US. So of course, fundamentally, we want to become a profitable company in the future, but we take a long-term view and think that it's important, as so many technology companies, to be able to spend money to then be able to have technology you're proud of, and of course, along the way, meeting significant tech milestones.
Have you got a need to be fundraising anytime soon? Will we see you going to investor base? How have investors reacted thus far?
So we've raised just over $100 million over the last 5 years. We have incredibly supportive shareholders who are very comfortable with the progress we're making, both from a commercial standpoint and, as I said earlier, the tech milestones. We're a private company. Who's to say what happens in the future? But right now, feeling good about where we're going.
So you're not going to have to go to your private investors anytime soon. There's talk in the press of burning through cash, etc. Yeah. But it sounds like a heavily investing area that you're in.
Look, I think fundamentally it's always about, is your board comfortable with what you're spending the money on? Is your board comfortable with the progress that you're making from a tech standpoint? If the answer to those two questions is a big yes, then that's exactly where we want to be.
That was Blipper COO Danny Lopez speaking with Bloomberg's Caroline Hyde. Coming up, Samsung is closing in on Apple's spot as the most profitable business in the world despite turmoil at the company. We'll dive into what's boosting its ascent next. And a reminder, all episodes of Bloomberg Technology are live streaming on Twitter. Check us out at Bloomberg Tech TV, weekdays 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. In deal news, WebMD has agreed to sell itself to private equity firm KKR. The deal is valued at about $2.8 billion, with the medical website agreeing to make itself private. WebMD is used by 70 million consumers a month. Comscore is out with its monthly internet user data for June 2017. Snapchat's U.S. app visits reached an all-time high of almost 90 million, while Pinterest's continued to stall, highlighting the risk that it may struggle to broaden its appeal beyond women to sustain user growth. Other sites like Amazon, Pandora, and Facebook continued to see visitor growth challenges in June. Well, Samsung has had a rough 12 months, from its exploding smartphones to its heir apparent on trial for corruption. But the company has been making positive strides. In its most recent earnings report, it announced increases in sales and operating profit, fueled mainly by the memory chip division and the new Galaxy S8. That growth now has the company closing in on Apple's spot as the most profitable business in the world. Bloomberg Global Head of Tech Coverage Brad Stone traveled to Seoul to take a closer look at the South Korean conglomerate, or Chaebol, and detailed the turmoil at the company in the latest edition of Bloomberg Business Week.
first of all, Samsung was great. They collaborated on the story. They brought us in. We probably talked to 6 or 7 senior Samsung executives. We got a look at their new chip facility, Pyeongtaek, which I'd love to tell you about. But yeah, it right now is poised to be the most profitable company in the world, overtaking Apple. We'll see when Apple reports. And the largest semiconductor maker in the world, overtaking Intel. It's remarkable. So, with all of this sort of, crisis around the company, its chairman, J.Y. Lee, or nominal chairman, on trial now in South Korea for corruption. The Note 7 debacle last year, it's a company that is really executing well.
Right. Last year, we had a question of whether Samsung and the brand would ever be able to recover. And here now today, talk to us about the trial of Jay Lee and how that's impacting the company.
Well, I mean, you have to understand the Samsung Group, right? It's a coalition, a consortium of 60-some public and private companies. There's a founding family that kind of hover above it all. There's a sort of coordinating group which has now been disbanded. So they're, the leaders have been, kind of charismatic figureheads dipping in to make major decisions, acquisitions, major investments. But in South Korea, this is a political situation. It's really kind of turn the tide of public opinion against these big chaebols, these big companies like Samsung.
Which are the South Korean conglomerates. I mean, what's the likelihood that he's going to emerge from this unscathed? Or
it's possible. I mean, they haven't produced a smoking gun, and the allegation is that they basically persuaded the government to put pressure on the shareholder group, this pension fund actually, to go approve a Samsung merger to shore up the family control of the whole conglomerate. There might, if there was a quid pro quo, it was probably an unspoken one. They haven't, produced a smoking gun. So I think he probably gets out of this ordeal. We'll find out in the next couple of weeks. But there is precedent for the heads of these companies to go and spend some time in prison. South Korea just seems to have a very conflicted relationship between the government, the people, and these large companies that have fueled its economy.
For all the things that Samsung is doing well, there's still this big thing that they have not tackled, which is software, which may be the primary reason that people don't buy Samsung phones or choose Apple over
they've never quite figured it out. I mean, let's do contrast. Pyeongtaek, in 2 years, they have spawned a massive semiconductor fabrication facility. I mean, Intel has been working on the chip fab in Arizona for 5+ years, right? And Trump has tried to put pressure on it to complete it. Samsung, deploys kind of militaries of construction workers and automation to go and get these things up and running. That's why they're so powerful. It's a different set of skills, the militaristic discipline, than you need for the creativity and entrepreneurship of software. As an example, they're releasing this Bixby personal assistant around the world right now, kind of their Siri, and there's been some kind of criticism how they've presented it, some in a kind of gendered manner, in how it answers queries. So this is the thing that Samsung has always had to master. There's some bright spots like Samsung Pay. It's having some traction around the world, but lots of sort of failures. Their Tizen operating system, which never caught on. It's kind of their last frontier.
So what was your impression from within the company, speaking to 6 or so executives, as you say?
Well, that they've remarkably recovered from the Note 7 debacle. It was a hard year for them last year. They've just re-released the Note 7 in South Korea. Like, what company would do that, right? The brand literally went up in flames, and they're back with it. The Note 8 is coming out soon. The Galaxy S8 is out and has gotten good reviews. So my impression is of sort of relentlessness that they deploy so many resources. They're so disciplined and efficient that they're kind of tough to beat. And like particularly on the manufacturing side, it's this area of strength that an Apple or a Google can't really counter.
Apple shares under pressure today. What does it mean for Apple given the iPhone 8 expected release in September?
I mean, the funny thing about Apple and Samsung, right? They're frenemies. Those Samsung displays are in Apple products. Samsung memory chips are in Apple products. Apple has a reliance on Samsung even at the high end of the smartphone market. They compete. So
yet they're trying to change that, right, by designing their own chips.
Right. But they don't make them. Samsung makes the chips, and so it's a tremendously difficult competitor to unseat. And the problem is that Apple can't get out of its reliance on Samsung because Samsung has went and tortured and all of the competition. So it's very hard for Apple to go and wean itself off of Samsung, and as a result, Samsung can rely on Apple and its business to go and basically subsidize a smartphone business that competes with it.
Bloomberg's Brad Stone there. Well, Chinese mobile phone maker Xiaomi is pushing into online lending and other P2P financial services. Speaking in Shanghai, Xiaomi's head of consumer lending, Chang, tells Bloomberg's Asia correspondent Stephen Engel that China's fintech pie is big enough for them.
Over the past few years, we noticed a lot of problems in this industry. This industry needs some regulation in place to enforce the activities and behaviors, and to make the industry to develop in a good way.
Is it important then to innovate before those regulations stifle the innovation?
Well, this is it is difficult because innovation sometimes needs more space to innovate. At the same time, if a lot of players in the market are not self-contained, regulated, the government and the regulation rules needs to be in place to make sure everything is fine.
What is the biggest risk to you, though?
First is risk management. Many people are the debt to income ratio is so high, some of them may have trouble to pay back. And the other side is financing side. Over the past few months, we've seen the cost of fund increase so huge and squeezed our profits. So that's two risks I've seen.
Now, Lei Jun, your chairman, has talked about the troubles that Xiaomi has had of late, losing a little bit of market share, also sales coming down. He talked about maybe the company grew a little too fast. But in financial services, are you a little bit late to the game?
Well, I wouldn't say it's late. It's just about the timing to extend our business into this space. We have over 200 million phone users and over 60 million IoT devices connected. So that translates into a lot of customers.
But are you at a disadvantage because you don't have the nearly billion users or whatever that WeChat has,
yes,
and you don't have the multi platforms that Alibaba has? Mm-hmm. So you're limited by how far you can go.
Chinese market is huge enough. So as I see it, we have enough space to grow. Even we have so huge monsters, competitors in the market.
Monsters?
No, maybe I take this back. I mean, big players in the market, but we still have the space to grow.
That was Xiaomi's head of consumer lending, Chang, with Bloomberg's Stephen Engel. Coming up, the public battle between two tech titans, the war of words between Elon Musk and Mark Zuckerberg about the future of artificial intelligence. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Uber is at risk of losing out on another big chunk of the global market. Grab, the leading provider of ride-hailing services in Southeast Asia, announced it raised $2 billion from Japan's SoftBank and China's Didi Chuxing. The company says it's also expecting another $500 million from new and existing backers. The move is just the latest hurdle for Uber as the startup struggles to right the ship amid a series of scandals. Well, it's the battle of the tech titans over the future of artificial intelligence. In one corner of the ring, Tesla's Elon Musk warning that AI may be a potentially existential threat to the human race. On the other side, Facebook's Mark Zuckerberg, who said last weekend he is very optimistic about the technology and thinks Musk's doomsday scenario is, quote, pretty irresponsible.
With AI especially, I'm really optimistic. And I think that people who are naysayers and kind of try to drum up these doomsday scenarios are I don't understand it. I think it's really negative, and in some ways I actually think it's pretty irresponsible, because in the next 5 to 10 years, AI is going to deliver so many improvements in the quality of our lives.
Musk responded on Twitter Tuesday, saying Zuckerberg's understanding of the subject is limited. We took a ringside seat to the war of words with our Bloomberg editor-at-large, Corey Johnson, and Bloomberg Tech's Sarah Fryer.
Elon is, for the last couple years, just been beating this drum about how afraid we should be about the eventual takeover of the human race by the robots. It sounds like
Larry Page's robot
fiction.
army specifically has warned about.
And you know, there was a few weeks ago, he spoke to a conference of governors and said, we need to be very proactive about the regulation of artificial intelligence before it's too late. Because most regulation in the government is, you know, once something bad happens, then you react to it. He said that by the time something bad happens in terms of the AI taking over, it will be too late. So.
Meantime, Zuckerberg is saying, look, we're already on this path. Yes. I think AI can be helpful in a number of ways. It's not, the future does not look as dramatic to him as it does to Elon. Corey, give us the other side.
Well, I think, you know, when Facebook looks at how they're trying to use machine learning and artificial intelligence, they're trying to, within the realm of Facebook, come up with faster answers to the things that people are discussing, get them closer and closer to services where people can spend money, either in Facebook or just use Facebook and Facebook Messenger in particular as a forum for making a lot of decisions and doing a lot of things. I think when Mark Zuckerberg looks at this, you know, it's not unlike his view towards privacy, which is that because I'm a benign and kind person, you should expect that the technologies that come from my company should be kind and benign. I think it's also important that these are people who have all kinds of advisors and all kinds of public posturing. These aren't two knuckleheads sitting on their couch on Twitter. You know, Mark Zuckerberg very much wants to put this image out there of we're technologically friendly. Technology is your friend. I'm your friend. Facebook's your friend. Love us. Elon Musk wants the governors and everyone else to think I'm a visionary genius. I'm imagining a future you can't possibly imagine. Loan me money so I can build electric cars and spaceships. So I think.
And Elon does say, you know, I've seen things you haven't. I know more than the rest of you about this. And I'm in a
he's definitely saying I know more than the rest of you, and I know more than Mark Zuckerberg.
Is Elon being dramatic, or does he have a point? Because there are a lot of unknowns.
I mean, he has a point, but at the same time, Zuckerberg doesn't want to stop progress in its tracks just out of fear, and that's what he's saying. I mean, there's so many things to fear about Facebook giving your data to this sort of nebulous organization, and you're right, Mark is trying to humanize it. I mean, he's going out there, he's being friendly, he's meeting people around the country, and trying to be unthreatening and approachable.
Think about what his business model is, right? Mark Zuckerberg's business model for his company is to get very intrusive information about people.
It's about being open.
And put it out there in a friendly way. Well, I would say it's about being open. It's not about sharing the information with everybody and you know, people are providing information, Facebook's using it and trying to put it out there in a nice way. Elon Musk's business model is, I'm smarter than you, I can see the future and you can't give me your money.
Sarah, this is not the first time they have sparred in public. So what do you make about the public nature of this?
It's so rare. I mean, Zuckerberg, like we spoke about, he's been going out and doing his tour of the country, trying to relate to people. It's so rare that he says something negative about somebody else publicly, let alone a mogul, right? And the
last time this happened?
The last time this happened was when a very expensive disaster occurred. There was this rocket that was supposed to take a satellite for Facebook into space to spread internet access to underserved populations, and it was Elon Musk's rocket, and it blew up on the launch pad. And Zuckerberg was so disappointed that he wrote a public post saying that he was disappointed in SpaceX specifically.
That was Bloomberg's Sarah Fryer and our editor-at-large, Corey Johnson. And that does it for this edition of the Best of Bloomberg Technology. We will bring you all the latest in tech throughout the week. Tune in each day, 5 p.m. in New York, 2 p.m. in San Francisco. All episodes, of course, are live streaming on Twitter. Check us out at Bloomberg Tech TV weekdays. That's all for now. This is Bloomberg.